All right, so hi everybody. I'm lucky enough to here have Adam from Future Set Mortgage Broking. Adam, thank you for joining me.
Thanks for having me here, Gianni. It's looking forward to chatting with you today. Excited.
Awesome, good to hear. Adam, I've been hearing a term a lot lately, and that's mortgage prison. Now, I was hoping that you could explain to me like what a mortgage prison is exactly and what people should be aware of, and hopefully don't find themselves in this position.
Sure. So, firstly, on that, you don't go to prison with your mortgage. Nothing to do with that. It's purely just a case of, yeah, people are sort of, they've got home loans and they're sort of sat there thinking, I don't necessarily want to sort of spend the time refinancing, changing lenders. And what they tend to do is then sort of leave things for months, maybe even years. And as you know, interest rates have been going up a lot over the past sort of 12 months. Um, and some people may think like, well, I'll just wait till a day when I've got time to do it and I'll refinance then and consolidate my debts or get a better interest rate. And what people are finding is they're sort of getting to that sort of spot and they're sort of then speaking to a mortgage broker, going through their financials, and then realizing then they can't service a refinance dollar for dollar to another lender. Basically because when a lender looks at someone's financial position, they look at the actual interest rate that they're advertising. Say it's 5.5%. What a lender will do is add 3% buffer to that. So they assess you as if you're sort of making repayments at 8.5%. So then you've got to sort of have a surplus of funds in your sort of calculations, essentially. So if that's the case and you don't show a surplus, then you can't refinance. So then you're sort of stuck in this mortgage prison or mortgage cul-de-sac where you sort of can't get out from your current lender. So you can't go to any lenders. Your lender's not giving you a better price or discount, and you're sort of stuck. So that's what that sort of mortgage prison is. It's like, you don't want to get sort of trapped there. You want to keep your options open. So my sort of advice to my clients or to my network and connections and to anybody out there is just don't wait to refinance until you have to do something when there's a panic there, or you find yourself in a situation where you're struggling with cash flow, whatever it is. Start to do the sort of the assessments way sooner, so you know what your options are, whether you can service or not, and if you know that, you can then start to make plans going forwards, basically.
Yeah, and I think that's one of the benefits of working with a mortgage broker as opposed to a sort of bank lender, because with a mortgage broker, you do regular reviews of your financial situation, make sure your loan is more appropriate for you, and make sure there's no sort of changes in your circumstances that that mean that that loan isn't sort of fit for purpose any longer. Can you sort of maybe touch on maybe some of the conversation points that you have in your regular reviews, and how often do you think people should have regular reviews of their loan?
For me personally, with my clients, I'm sort of, once somebody becomes a client, I do an interest rate review on their file every 6 months. So that's me basically looking at their current rates and going to their current lender and saying, look, this is what I'm seeing out in the market for similar loan to value ratio type sort of loans, same sort of products. There's more attractive rates out there. Can you offer my client a discount based on this, on a retention piece? And I would say from my end, probably 7 times out of 10, I'm getting a reduction from my clients when I just by asking the question, saying, you know, can you give the client a reduced interest rate price? And it's surprising what comes back.
Mhm.
Obviously, people can do that themselves, but what people tend to do is the months tick by, the years tick by, and they don't do that, and the interest rate just creeps up in the background. So look, for me personally, I think every 6 months the broker can do that. If you build in a process to action that, then there's no harm in asking. And if you get a reduction, it saves the clients thousands of dollars. Outside of that, should always be an annual review and also a 2-year review at the absolute minimum. So if you're not getting any reviews within 2 years, then look, you should be getting a better service. That, in my opinion, because by doing that, you can then see, look, if you were to go to another lender at this point in time, you could save thousands of dollars. And you might say, if you didn't have that sort of service in place, well, how much more you're going to be paying in interest to the banks and lenders, which you don't necessarily have to be doing. So it's just, again, also doesn't mean like the client has to refinance or has to move on. If you're saying, look, these are the options that are out there, what are your thoughts? And they say, look, I'm adamant, I want to move, then great. If they don't, that's totally fine as well. So it's not you have to transact. It's just a case of know your options is the key when it comes to home loans and mortgages.
I think that's the other thing as well. That's a really good benefit around, going with yourself or going with a mortgage broker, is that you're proactively trying to get them a cheaper rate. Because I know for human behavior, not everybody sort of challenges bills when they come in. Like a big one is insurance premiums for me.
Mm.
Sometimes spending 15, 20 minutes on the phone with an insurance provider can save me hundreds of dollars in premium costs. And if there's somebody doing that for me on my behalf, in your case, in my case, like yourself, a mortgage broker, then that's a really big benefit for me, because you're proactively trying to save me money on my investment loan, home loan, mortgage, etc. So that's actually good. And then another thing as well is, we sort of think that things don't change, but there could be changes in our personal situation, or there could be changes in rates and policies from lender to lender. So I think that's one thing that people don't understand. A lot of people sort of just think a home loan is a home loan, but maybe could you provide a little bit of detail on what some of the differences between rates and policies are from lender to lender?
Yeah, 100%. I mean, rates and policies will vary literally by lender to lender. So you may be, say, for argument, with a major bank for the last 10 years, and you've spoken to them a few times and they said, look, we can't do anything. This is what our options are. And some people then take that away and go, that's my whole scenario. I can't do anything with anybody else because I've been told by this particular lender. Now we've got 50 lenders on our panel, and there's always different options available, different policy niches. And some lenders might have the same policy around, say, for argument's sake, maternity leave or probation, but their individual policies are different each time. And for me as the broker, and any good broker will basically search through all those lenders to find where your situation will fit nicely with the sort of policy. And the idea is to sort of give you options around, say, look, with your situation, the policy niche that you're looking for, these are the 2-3 lenders that we would recommend. And at that point, then when you've got options, you can then start look at the rate. Go, well, of those 4 or 5 lenders or 10 lenders, how many you've got to choose from, who's now going to give you the best rates from the options? And that's how you, as a broker, I would assess it, rather than going rate first, can't fit policy, next lender can't fit policy. That's the sort of the back way of doing it. So yeah, it's just really sort of people just really need to sort of know that, look, because you can't do what you do with your current lender, there's plenty of lenders to choose from. But to do it yourself is really difficult. Like, how are you going to speak to each bank, lender, talk about policy on the phone to customer services, know if it's services or not, or it's just too hard. So for me as a broker, I can do that essentially in a matter of minutes, hours, by doing that assessment. And you mentioned about, people look at their sort of financials and go, things change. Is part of my process with my clients is we do a full sort of living expenses audit. So we look through all your bank statements, credit cards, and provide our clients with a sort of a 12-month report that says this is exactly where you're spending all your money in dollars, month by month, category by category. So if people say that I want to reduce my living expenses, to tell them to go and do that themselves, it's like, who's got the time to do that? Who's going to sit through and analyze all their statements? Like, you get an account to do it, there's a fee there. We do that as part of our service for our clients as the value add, to say, look, we'll give you that report. We'll give you an analysis. This is what you can take out. This is what you could consider taking out. And again, it gives the client choice without putting all that effort into sort of analyze all that as well.
Yeah, okay. Yeah, because I think that's one of the things as well that people don't really understand, is that if you were to say do it yourself and compare a few different lenders, you predominantly, I'd expect people to go to a few of the biggest banks. They're not really going to they're not really going to 50 lenders on a panel and comparing the definitions of certain terms. They're not going to go through that comprehensive a detail. So they need to sort of understand as well that, everybody's individual personal situation will determine what sort of lender that they go with, and mortgage brokers will go into the details of the policies as well and see how that fits their situation. So it's not really a one size fits all. In addition, I know that some lenders are fairly risk adverse as well. So, they won't be willing to take on risk. So even though a policy might fit your needs, that you don't fit their sort of category in terms of risk appetite. So that's another thing as well. But it's good to hear that you work with people to understand their expenses, because, look, I'm a big advocate of financial literacy. And I think one of the best things you can do is look at your own expenses and audit your expenses in order to save a dollar because I know that a dollar saved is a dollar earned, whereas a dollar earned still needs to go through tax and account for inflation and that sort of stuff. So one of the biggest things that people can do is audit their own expenses.
Yeah, and I agree. Like, and I said, when you come to that yourself, it's like, well, some people look at the last month and think I've done an analysis, but the month doesn't give you the full picture, because obviously there's things you're paying on a quarterly basis, on an annual basis, so you need to factor all that in. But again, have you got the sort of the Excel knowledge spreadsheets to do all that, analyze it, and you're running, say you've got a household of running a family, it's just who has the time to really do that? So again, it's just, if you can get that done for you, it makes a huge difference. And the things with that, when I've done it for clients, they go, I didn't realize I had those monthly standing outgoings going out. And they say, we don't use, for argument's sake, we don't use Disney anymore, or Stan anymore. Let's cancel that off. Use that and make as an extra payment towards your home loan, as opposed to just paying it to a subscription that you don't actually utilize. And it can make such a difference. People think, oh, what's $20 going to do? What's $30 going to do? $30 extra onto your home loan, extra each month, can have a compounding impact on the interest you pay and how soon you can pay your loan down. Something that can be years you're shaving off the home loan term.
Yeah, a lot of people don't understand the concept of, look, I refer to it as delayed gratification. So look, $30 now might only be $30, but $30 in 5-10 years time could potentially be thousands off your loan. So a lot of people sort of think, oh yeah, it's only a cup of coffee, or it's only $30 worth of streaming services. But look, another thing as well is to have that third party, to have a sort of, non-biased view of somebody else's expenses and budget. It can stimulate a lot of conversation as well. And in some occasions, I've actually seen like husband and wife actually get a little bit touchy about certain spending. What are the sort of conversations after that you sort of have when you make the budget transparent for people?
Yeah, I mean, most people generally are open to go, oh, I didn't realize that. Because what happens when they do initial fact find, to sort of put the information into our system, they'll estimate what their expenses are. And I can pretty much say 90% of people are always well under what the actuals are. And that's quite a key important thing to take away, is because if you don't know that figure and you go and take on a home loan and you've used the wrong sort of living expenses, you don't want to find yourself in a position where you, in the real world, you can't actually afford those repayments. So that analysis of knowing exactly what you're sort of paying out over 12 months, when you sort of onto a monthly basis, is really important to protect yourself. And that's what I do from my clients, is to protect the client, to make sure they can definitely afford these repayments given the current lifestyle. Now, when I do that analysis report, most clients will say, if I didn't do the report, people would say, I don't spend that much. And I would be like, well, then it becomes a sticky conversation to have if I don't have the evidence. So prior to that conversation, I send them the report with the breakdown, and then they can go through and just basically see it in black and white. Like in subscriptions, it's Netflix and Stan, and this is how the figures are worked out. So it sort of nullifies that sort of situation. They go, okay, that's what it is, and we need to make changes. But if say you can still service the loans with this current living level of expenditure, you can continue forward. It's when it sort of reduces your borrowing capacity and your serviceability, and you can't move forward now because your expenses are way higher than the lender benchmarks. That's when you've got to make change. Say, look, you need to sort of take these expenses out or go away, rethink about how you spend your money, and then we can look at another situation again.
Yeah, I think the other perspective to look at as well is people might not understand that they're in a better financial situation when a mortgage broker views their, their lifestyle, their assets, liabilities, etc., and they may actually have equity available to invest into an investment property or other assets as well. So that's one of the benefits that a mortgage broker can say, well, hey, actually, you have potential to, go out and better your financial situation.
100%, and that's the bit that I'd really try to educate my sort of clients on and connections on, is around knowing those options that you can draw equity out, to either do renovations, to put in a new swimming pool, whether it's to buy investment properties, how investment properties can help you to create wealth and passive income, and how you can use those investment properties to pay down your owner-occupied home loan debt sooner if you're positively geared. And that's one thing, when I bought my first property, that I never got told that. I got a home loan and I sat there, and even the mortgage broker did a great job at the time of getting me the loan, but the ongoing education and sort of just that support around these are the options you have going forwards was never presented. And if you're not careful, that those months turn into years, and it's like you can look back and go, 10 years ago I could have bought potentially 2 or 3 investment properties. And then people go, well, investment properties, do I need them? What, it's more debt. And it's again, it's just again understanding the types of debt, good debt, bad debt, and going, well, how am I going to create sort of wealth in retirement? Is the super fund going to give me enough in retirement? Can the investment properties be a vehicle to support that? And it just starts to open up the doors when you start to talk about those things. And if you provide that education to your clients, then they start asking questions like, I want to benefit from that. And they don't necessarily then see debt as like, all debt's bad, don't want it. It's the more debt you can get, investment debt that's earning you an income is great. But if you can't get it, that's when your options are limited, and that's not the place you want to be. So yeah, it's just really sort of just helping clients to sort of understand that, but at the same time, without doing it in a way where it's like, come and sit on this 4-hour seminar and become an expert. It's just, you can just basically tap into sort of anecdotal videos, start asking questions, and let the mortgage broker and the buyer's agent, the accountant, start to sort of guide you through that sort of process, and why you might consider it. And to not make you feel like you have to do it, it's just a case of, these are the options, what are your thoughts? And that's how I would present it to my sort of clients and connections.
Yeah, that's big. And I think people don't have that sort of mindset either, because a lot of people will have the sort of mindset that debt is bad, but debt is essentially a tool, and a tool you can use for either good or bad. So like you said, it depends what that debt supports. Does it support, like a new car, or does it support like, some sort of luxury item? If it takes money out of your pocket, then essentially it's not serving you its purpose. But if you use debt to support something that puts money into your pocket, that, potentially purchase assets or investment property that will help you pay down your principal place of residence debt, then it's actually a good tool in that case. So yeah, that's why, one of the reasons why I'm really big on financial literacy as well. So it's good to hear.
And I think that with understand that, even for myself, I was an ex-accountant, ex-auditor. I was working for one of the top 4 practices in Australia, and still no one came to me and told me that. It's not like everyone knows, like, oh, he must be an accountant, he must know all this stuff. If no one tells you these strategies, you just don't know. And I said, you either find out later or sooner or whatever it might be. And the people who realize this soon and go, this sort of debt is good to get. Once they go past that sort of, or through that door, suddenly like, I want to get more, I need to borrow more, because they know there's a reason for it now, and it's a vehicle to get into a better spot in the future. But I did it myself. I was like, don't take on debt, property's too expensive, I'll wait, there'll be one day when I can afford to do it. And you just wait and wait and wait, and you now look back and go, if I just started smaller and built that portfolio to begin with, you'd be in a much better position in the future, sort of thing. So yeah, it's really just again, people should never feel sort of like, I don't know this, I'm not going to say it, I feel like I should know. It's just, if you don't know it, just start tapping into these educational videos, and it will really sort of accelerate your sort of knowledge to get yourself ahead.
Yeah, good to hear. Very good. All right, Adam, I think we've covered a lot of really good content, and I think we've added a lot of value to the audience. I really appreciate it. If anybody wants to sort of chat further about, increasing their financial literacy or understanding their home loan product a little bit better, how's the best way to get in touch with you?
Yeah, basically you can just go to my website, and you can find me on basically LinkedIn, Instagram, Facebook, TikTok. There's my links there to my calendar, so you can book a time straight in for a chat. You can obviously Google me, give us a call. And that initial chat is always like, initial chat. What is it you're looking to do? What questions do you have? And I'll tell you the next steps in the process. It's not like a sit down formal, be scared of this, talking to someone about finances. It's very, very open, and we get the process sort of started. And it was just a case of clients saying, look, I want to have a chat to you about a particular thing with my loan. I don't want to transact right now, or I don't want to refinance, or don't want to buy. Just get in contact, start having a conversation, and get the sort of wheels turning, and go from there.
Yeah, good to hear. Yeah, I think that initial conversation sometimes is the hardest. So that's great.
Yeah, I try to make that the almost the easiest, because it is just a welcome call. Just let's have a chat, and it shouldn't be daunting at all.
That's right. Yeah, awesome. Good to hear. Thank you again for your time, Adam. Really appreciate it.
Thanks, Gianni. Appreciate it, mate.